Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, April 10, 2017. Looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And we remain trapped in between the 20 and the 50 period moving average. But all in all, we have a pattern inside of a pattern. So we'll go over the larger one first, which is an up move off the bottom, and then sideways consolidation. Generally speaking, this is going to promote another move higher, at which point we will find a minor level of resistance at 237.61. However, there is another pattern that still could be developing and not complete, which is essentially this down move and a bearish pattern completing down in this zone here, which could happen over the next day or so. Now, I know that's conflicting information, so let's unpack it a little bit, pick it apart. The larger picture is the market should be bottoming out. We should be finding a low from the original corrective phase that began on March 2nd, about 5 weeks ago. Okay, so that was up in this zone right here. So we corrected for about 4 or 5 weeks. A little bit early we bottomed. I thought we would bottom around where we are now. However, we bottomed a little early, and now we're making a bullish consolidation pattern off that low. We haven't come back to retest the lows. That's still a possibility. However, I really am looking for a turn right about within the next 24, really 48 hours on the outside. And if the cycles are right and all things point to being correct, that turn should really be the beginning of the next phase of the market going higher. The only thing that changes that picture for me is if we were to close a day below the low of 231.61 from the 27th of March. We would have to close below and confirm below that level for me to change my tune that something else was going on and the market was not necessarily going higher imminently in the short term. Outside of that, barring any close below that level, the market should turn higher and stage the next leg of the rally that should last at least for the next 6 to 8 weeks. All in all, from an intraday perspective today, just to bring that up, we basically didn't have a great close. We rallied early, failed, tried to rally again, put in a lower high, which is never a sign of strength, and finished below the moving averages, finishing lower into the end of the day. That's never a good sign. That generally spells a little bit of weakness leading into tomorrow's activity early on. But all in all, the bigger picture is we're trapped in between the moving averages. A little bit of a down tech isn't going to make or break anything unless we have a larger sell on our hands. But today's volume was very light, 67 million shares, so it's very hard to make too much out of today's activity. When you look at the IWM daily chart is weaker than the S&P all in all. The S&P, while making a bullish pattern, the IWM really isn't making anything bullish whatsoever. In fact, if you had to say the only prevalent pattern in the IWM happens to be a bearish one inside of another bearish pattern. So let me show you what I mean by that. So the longer picture is we have the bearish pattern, down move, and this could be a continuation move. That is possible in the IWM. The second pattern that I see in the IWM is a down move and an inside wedge pattern setting up for another down move. So you have two bearish patterns inside of each other in the IWM. So the IWM is not signaling anything of strength. So you have to question the larger picture, at least until and unless the IWM seems to make a break to the upside and begins to close above some important levels. The first important level would be a daily close above 137.43, a daily close above 138.10, and then most certainly a daily close above 138.60. Until and unless those things begin to happen, the IWM happens to be signaling lower prices ahead. Now, one of these two things, when markets diverge, one of the two things will tend to catch up with one another, and either the IWM is going to catch up on the upside to the bullish pattern that seems to be developing in the SPY, or the SPY is going to break down a little bit and the shorter term bearish pattern is going to take hold, finishing the IWM completion down to at least double bottom off this inside wedge pattern that seems to be developing in a bearish formation. So I know it's diverging signals we're getting in the IWM versus the spider, so we'll continue on and take a look to see what else we have. When we look over at the VIX market, now the VIX was up 9% today. Now that's a pretty big up day in the VIX, especially when the overall market was really near the flat line. When you look at the bigger picture on the spider today, the spider was basically up less than 0.1%, up 14 cents. So the spider was basically flat. The IWM was up 28 cents or 0.2%, yet the VIX had a big juicy update on day up on the upside. So that does seem to be in concert more with the IWM weakness, and I don't mean intraday weakness, just overall pattern weakness in relation to the spider. So the VIX is telling us that downside may be coming, and the VIX, when you look at where we are, is this just a retracement, or are we going to challenge the highs from the 27th of March at $15.11 on the volatility index? That is possible from where we sit right now. We'll see if we get through there. I'm not 100% sure we do. But as we know, the market never makes it easy. The market's job is to fool as many people as much of the time, as many people as possible, I should say, as much of the time. And right now, you have some diverging pictures out there. And if I had to say, based on today's close, the IWM and the VIX, at least in the very short term, meaning tomorrow's activity, for example, maybe the overnight activity in the S&P futures, seems to be pointing to more negative behavior than positive behavior. That's at least what we can see on the surface. We do have a lot of geopolitical events taking place or unfolding. They're fluid by nature. You have Syria brewing up. You always have discussions about North Korea. You have the Russians in the mix. Who knows where the Iranians stand? You have a lot of homeland political stuff going on. Discussion about tax cuts, no tax cuts, delayed, not delayed. So we're never really at a shortage of information. So where the market decides to take a cue from that information is going to be interesting over the short term. But I still contend, regardless of what happens over the next day or even bleeding into Wednesday, my contention is that the market should be looking for a final low, preparing for the next leg higher. Despite the divergences that we see, those could be just signaling very short-term market behavior. When we go over to the transportation average, we have yet again another divergence. So there are divergences all over the place. The transportation average is bullish. We've been discussing bullish behavior. It's been a bullish consolidation pattern. It wants to get up to a minimum of the 50-period moving average up at 92.50, most likely higher. Overall, it's going to go higher as long as the market gets a lift. But the transportation average is signaling higher prices, and we have two primary leading market indicators, whether it be on the upside or the downside, both of which right now seem to be more of a diverging nature than anything else. And I find that interesting. The transports are obviously telling a tale of higher prices, and the IWM just hasn't been able to catch a bid and is showing signs of weakness. These two things will clear themselves up, and they both will trade in tandem ultimately. But right now, we have to just recognize the divergences when they do exist, and we have to wait for the market to give us the right signal, giving us the highest probability of success where the odds are mostly leaning in our favor. And right now, with several diverging indicators, and basically we have kind of a 50-50 split, I would rather just wait to see some of these things clear up and let a little more time run off the clock. It's better to be more certain in a trade than take more risk that is generally, by nature, undue risk. Let's take a look at another market. Since we're looking all around, let's look at the NASDAQ. And what we have in the NASDAQ is, again, very similar to the spider. We have a very short-term bearish pattern that could certainly take us down to 53.75 in that neighborhood. And that is a bearish pattern that may, this low here, 53.82, that could be the downside target of this bearish pattern. But inside, the bigger picture is bullish consolidation. So even though we had this down leg here, that was the beginning and this was on March 21st, pardon me. This was the beginning of the corrective phase. This was a big down day. But all in all, when you look at the longer picture, there's nothing wrong with this market. This market just wants to go higher. It's just pausing and going sideways. And so on a weekly basis, this is another big weekly up candle, and we're just consolidating inside that. So there certainly can be some backing and filling inside of a weekly candle, intra or midweek activity back and forth. But this wants to go higher above all the moving averages. The moving averages are spacing. They're sloping upward, which means that the trend is up, and therefore the NASDAQ is telling us the tale of longer-term higher prices. How about intraday, the XBD? A downward move. This looks more like the IWM than it does any of the other markets. So the financial sector, as measured in our case today by the broker-dealer index, is a more bearish pattern than anything else below the 50 and the 20 period moving average, and basically continuing to make a bearish pattern, really telling us that this wants to get down to around 200, potentially the 200 period moving average down at 190. This is yet again another diverging index. We have too many divergences to make a sufficient call one way or the other. You can see when I run down the list between the spider, the IWM, the VIX, the transports, the NASDAQ, and the broker-dealers, everything we looked at tonight, nothing looks the same other than the broker-dealers and the spider. Pardon me, the broker-dealers and the IWM look the closest. Here's the broker-dealers, and here's the IWM. They don't look the same, but they look similar. They look like they want to break down farther. Until one of these diverging attitudes, if you will, in some of these markets clear themselves up, then the odds favor a no trade right now until we get more clarity one way or the other. All right, going over into the gold market, we saw gold spike higher, run through on Friday the 200 period moving average, never quite got up to the gap fill. We came up like within $1 or so. We got as high as 1273.30. My number was 1274.90. So we got it within $1.60 of filling the gap and backed off pretty substantially from where we were to where we were earlier today. But all in all, nothing happened. This is still a bullish consolidation pattern. And right now, not that I like correlations, and you know I don't, but since I'm talking about correlations, we do seem to be currently somewhat correlated, or negatively or inversely correlated, between the stock market and the gold market to an extent. So when we do see some selling pressure in the stock market, we do see gold catch a bid. Not every single time, but I am noticing that. So we do see a bullish pattern in gold, and we do see some bearish formations around the stock markets, not in its entirety, but certainly around the stock markets. So I think that's something of note, and I'm putting all these pieces on the puzzle together on the table because I think they're all important and they're all leading us to something. Whether they lead us to a quick flush lower, yet to turn around and run higher just to fool as many people as possible, which is completely possible that that happens, or something larger developing on the downside, which I'm not 100% sold on. It's possible, but not probable. One way or the other, something is developing here. The market's coiled up and it's going to make a move, and I think it's going to make a move sooner than later, and I think tomorrow is a pretty good recipe for a tip-off of, at least in part, of one of those directional moves, if it's going to be two. Down first and then up, or we just go up, or something else is developing and we go down farther than I anticipate. Any one of those three scenarios is possible. I just think the least probable is straight down. That's the least probable scenario, okay? So bullish pattern in gold, looks like it wants to continue to go sideways, preparing for another move higher. I think on Friday was potentially just a peak higher, setting up prices to go higher yet from where we were, or from where we are. Now, silver broke out of this, didn't break the bullish pattern, but broke out of the tightness of the bull flag pattern, essentially, that was developing in this upper range. That happens a lot, and that's why it's very hard to buy these patterns in the upper range, because they always want to come back down. Not always, but a lot of time, they want to come back down and test the breakout point. In this case, they tested the moving averages. They closed above this green candle low, which is important, at 1778. That's an important hold. As long as we hold 1778, this is in a bullish formation. Any daily close below that, and this bullish formation is off the table as it stands, technically speaking, today. So silver still bullish according to those parameters. Going over to crude oil. Had a nice healthy update in crude oil today. We're above the $53 number, $53.15. I mean, I suppose this can get up to $53.30, maybe even $53.60. I'm not 100% sure we can get above this by much, maybe just a peak above, but I would expect it to stall out here. And of course, there's some geopolitical evidence or geopolitical tensions around the world that certainly play a part in rising crude prices, whether I like it or not, or whether anybody else likes it or not. So the tensions in Syria, including Russia and Iran and all the normal players in the Middle East, definitely can put a bid underneath crude oil. Whether that's long-lasting or not remains to be seen, but we can certainly, I suppose, move all the way up near 54. I would find it very, very difficult to close above that number or that area. However, the geopolitics could obviously prove me wrong, but that's my take on it. It's not a place to be long, and it's not a place to be trying to short crude oil. I'm just stating what I'm seeing on the chart. It's not a high probability trade in either direction from where we sit today. Going over to the bond market. The bond market continues. It looks very similar in its nature to what happened to gold on Friday. It peaked above 152.23 and backed off, but continues to consolidate in this bullish fashion, just like gold does. I think these two markets are trying to tell us something. And you know what I always say, the bond market participants are always more intelligent than the stock market players. And I think the bond market right now is telling us, or trying to tell us something. The gold market may be telling us something. If these two markets break out on the upside, I suspect that stocks will come under pressure, if for nothing else than at least on a temporary basis. And I think there would be downward pressure in the stock market with a spike higher in bonds and gold. That's the way I'm reading it. Crude could be the wild card. But that's the way I'm reading these two charts in bonds and gold, using all the evidence from all the leading indicators and all the markets we look at. I'm walking this through, I'm thinking this through as I'm making this video with you, and at least in the very short term, my bias has to be to the bearish side of the stock market in the very short term. That could be just the morning tomorrow. That could be a day and a half. I'm not sure it's extending more than that, but that's where my intuition, if for nothing else, is leading me as we walk through these different markets. And in the dollar, we basically just saw a pause in the dollar after a nice rally higher off these bottoms, or off this bottom. That was a nice run. We took a nice 3-day surge up. We consolidated for 4 or 5 days. Another pop higher. We didn't quite yet challenge the red candle high at 101.59, but that could still happen with a spike higher in bonds and gold. Dollar could potentially follow over the next day or so. We'll see what happens. Either way, basically, I think as we kind of wound this video down and we look through all the different markets, I think you'll see where my short-term head is at. Nothing's changed from a longer-term perspective. And just to wrap up where my line in the sand would be on the spiders, my line in the sand on daily closes is still going to be ultimately 231.61. But I really don't want to see this pivot low of 233.91 from the 3rd of April. I really don't want to see that taken out on a closing basis. If that gets taken out on a closing basis, I think this market has more downside coming. So that's my first indication that there could be trouble if we close, for example, tomorrow below that pivot low at 223.91 right here. That's going to be the first sign of trouble, and what would tell me that we have a high likelihood of actually going down and testing these lows here. So that's where my head is at. That's what I'm thinking. You see all the leading market indicators that I look at, and they're all telling me a different tale, but I think some are leading in more than one direction, or some are leading in the direction that points me to short-term pressure on the downside in the market, but in the short term. And with that, folks, I'm going to leave it there tonight. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.